you see the light green area, the entire activity back quite a ways would stay. And the reason that light green area, that area is that narrow is because that represents how long I'm in this trade. This is a 14-day trade. We're talking about May 21st options here. So 14 days to expiration. So this only goes back 14 days, right? So that's how much time moving forward I have to consider.
Right? I like that. That's cool.
This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we cover finance, stocks, options, entrepreneurship, education, and money. And here's your host, voted one of the top 100 people in finance, Christopher Ewell. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, we have a special lesson for you. I'm putting it here on the podcast because I really believe that this is going to provide you massive, massive value. And that's what I'm trying to do here. And hey, listen, if this podcast was useful to you at all, I really highly suggest that you go check out the full trading course at AIStockTradingSystem.com. That's AIStockTradingSystem.com. Markets are people. People are predictable. Outlier can show you how to track market fear and greed with artificial intelligence on over 1,300 of the largest market cap names. Visit outlier.com to learn more. That's OVTLYR.com. They have a free pilot program for the rest of 2021, so you can get access to right now at OVTLYR.com. That's OVTLYR.com. Hey, make sure you subscribe and hit the bell so you'll be notified every time we give you more tools, tips, and tricks to help you trade faster and trade smarter every single week.
Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, we've got two of my favorite guests back. We've got Rance Mashek and Chris Mercer from MarketGear.com. And before we get too deep into it, if you want to start your own Market Gear membership, make sure you head to MarketGear.com/Chris Ewell. That's ChrisuHL. That's me. And there you'll get 2 weeks free and 50% off your first month of Market Gear. So guys, thanks for coming back on the show today.
Glad to be here.
So we are going to be talking about iron condors. Now, I have a love-hate relationship with iron condors because at one point in time, I thought that this was like the options trade to make. And little did I learn that there has to be a right scenario where the iron condors work, and I was not in that right scenario. So, guys,
can we ask what you were what were you doing to get in? Do you mind me asking that?
Yeah, I was like any just random day that ended in Y and the market was open. I was like, oh, I should sell iron condors. That's what I was doing. There was no strategy behind this. Rance, I am the most open book about the fact that I sucked and could not make money for the first several years of trading. So I love sharing that with people. Because I remember specifically, there was one day I was on a business trip. I was making these trades from my iPad. I pulled up my iPad. I was like, hey, I've got some capital to work with. Why not? So I put on like 8 iron condors. Like I said, literally thought that this was the way to go. Didn't matter if it goes up, if it goes down, if it goes sideways, you win all the time. Don't worry about it. And by the time like those 8 came off, I think 7 of them were full losers, and the one that won probably made like $8. And so like I said, I have a very love-hate relationship with them, or probably more hate than love. But it's all my fault. I gotta say, every time I bring this up, it's not the iron condor's fault. It's all my fault.
Well, there's a list of tools. There's a list of tools in options trading, and it really does matter how you use the tool. Like one of the things we were talking about this. We were talking about straddles several weeks ago, and you were talking about, were you talking about short straddles or long straddles? I said long straddles around earnings, and you go, wait a minute, that didn't make sense to you because of what your experience was. So what we were talking about is like, how do you find the right ones, right? So number one, does it tend to, you're not going to do this on, you're not going to play a straddle play on Pfizer or, some conglomerate, right? On an Amazon or on, something that has a high tendency to have a driving move around earnings, different story, right? So it's how you find that kind of opportunity. And the other one we talked about was when you get in where the volatility is, right? Because the volatility is too high. Same thing here with condors, right? It's the same thing here with an iron condor. It's what's the right scenario. And that's one of the things we're going to look forward to talking with you about today and go through a little bit of a couple scenarios on it and see if we can find some things that are interesting. So,
yeah, well, take it away from here. I'll let you go from there. But first, let's just describe it real quick. So an iron condor is where you're going to sell an out of the money put spread combined with an out of the money call spread You can put these at whatever distance you want out of the money. Some can be closer, some can be farther. And basically, you're boxing in the trade. Correct. The idea is for the trade to not move too much in either direction, up or down. It can go sideways. And when I first put these on, it was explained to me like oil or gas prices, right? Let's say if gas is $2 today, basically you're saying, I don't think it's going to go below $1.50, but I don't think it's going to go above $2.50. So as long as it stays between $1.50 and $2.50, you're going to win on the trade at expiration. And while that may be true with gas prices, these stocks that I used it on had a lot more movement than I had expected. So, Rance, take it from there.
All right. So, just as we just, I'm going to jump into a quick, there we go. A couple PowerPoint slides just to help drive us home a little bit. And now you mentioned, so by the way, as I do this, just a little comment here, we're going to be using real market stuff here. I don't want this is educational. This is not to be construed as a recommendation for a specific trade. And that standard disclaimer there we do, but we want to get into this. Now you actually, you brought up, I'm going to change my direction here on my slide a little bit. You brought up that you're putting on both, credit spread, call credit spread, a put credit spread at the same time, which is an absolute accurate way to describe it. It wasn't what I had in my slide here. So just to share it another way, okay. Right. It basically, I'm going to sell slightly out of the money call and put. Right. So if you think about it this way, if I'm just selling a call option, don't own the stock, right? Not a covered call, just selling a call option. What do I want the stock to do? I want the stock to stay where it is or go down. If I sell a put, I want the stock to stay where it is or go up. Well, when you sell both of it, you want it to stay where it is. But what we can do is we can work that range, right? On how wide we want that to be. Between the two strikes I sell, between the call and the put that I sell. But then what we do, so you can be in a naked straddle or a naked strangle. That would actually be if I'm not at the money, I'm slightly out of the money. And you can make money on those, and people do. The challenge is if the stock moves too much on you in either direction, you have an unlimited risk on the call side. Technically not an unlimited risk on the put side because stock won't go below zero, but still a massive amount of risk. And what we do is we go out and we buy the outer sides of those as a form of protection so that we don't have that risk, right? That's what we're trying. That's another way to say it, but it's exactly correct. You're doing a call spread on one side, a put spread on the other side, credit spreads in both cases. And you end up in that same type of thing. Now, there's a couple things of how you structure these. It's kind of important. So let me just make a little another mention on this. Then I'm going to bring up a risk graph and show a little bit of this. Basically, this is a protected way to be able to sell volatility. And if volatility drops, you're going to make money on the drop of volatility. It is generally thought of as an expiration trade, which I agree. It's you're generally going to write it out to expiration. The only time I'd get out early on something like that is if things don't go well for you, right? If it's if you're riding in a range and it breaks outside of that range, if you ride it to expiration, you get 100% loss. If you which by the way, 100% loss on the spread could mean more than 100% loss on what you took in the trade. We'll see that in just a second.
Absolutely.
Right? Yep. Because I could have a $5 spread, take in a $2 credit. So I got $3 at risk in that situation, right? So you got more at risk than you're taking in. So you just really want to watch that. Now, a couple things about this: it is a great way to generate cash flow, and it defines your risk in the trade. And you have to manage that, make sure that you're comfortable with that, and work that appropriately. One of the cool things about this is it can generate a pretty strong, we call it TVI or time value index. What time value index is really the same thing as what would that trade be if annualized. But if I bring in 50% in a month, that doesn't mean I'm going to bring in 600% in a year. Now that would be the TVI number would be 600%. But the reality is you're not going to do that. So we don't like to call it, well, that's an annualized return of this, because that's kind of a little bit of a false sense of that. So we call it time value index. But it does generate a nice cash flow for a relatively short period of time. So I think the best way to really do this is let's jump in and look at one real quick. I happen to have up, for those who are watching, this is the Marketer platform. I actually went straight into our strategies, into our Condors here. And
so Rance, go back real quick. I just want to see what steps you took to get there. I'm going to have it up on my other screen so I can follow along.
So if I'm from the home screen, I'm going to go into find scans.
Okay.
And then when I go into find scans, you'll be on this page when you first come in, right?
Yeah.
I'm going to go to strategies, and then I'm going to click on the Condors and Butterflies one.
Okay.
And then there's a candidates, and there's ones that's actually calculated out. So the candidates are, it's a great list of ones that are kind of stagnated. In fact, just to show you this really fast, because I think this is an important piece to consider as you're doing this. If you look at the stocks here.
Okay. I want to talk about this one because Chevron is at the top of your list, and I'm long Chevron right now, hoping for it to go up. So what constitutes the credit, or the not credit, but the candidacy of this?
The candidacy. Yeah. Exactly.
Candidacy of it. Well, so if you notice here, there's definitely a potential resistance up here. Let me just go into.
How do you shift it to the chart? Because I've still got it just as a list.
Great question. So if I go back to my scan here, over here on the top right-hand side, you'll see 4 little squares.
Oh, okay.
Right. That 4 little squares is select the tile view, right? And then the other, when you do that, now it shows little lines to switch it back to a list view.
Oh, okay.
Right. So this is the candidate list. And I'm going to tell you that what will happen is these can work. There's a lot here that can work, but I actually do like the ones that we're going to go back to that in just a second. The actual ones that we found through our system, which is only 5 of the 28. Right now. And the reason for that is that we cherry pick it, right? We want really good stuff of those. But if you look at this, there's a level of resistance. Let me go back to the chart. And so if you look at the chart here, there's some resistance that we expect up here. I will tell you that, this is definitely, it broke out from another level of resistance here. So, that may be part of why it's like, maybe it's in it, maybe it's not, right? It's a candidate, but weigh it out. I'd want to make sure if I did this, that I could cover this up to this risk point, right? Up to this resistance point. And then if it broke through that, I'd be looking to get out.
Right.
So I'd want a pretty wide move on this if we're going to do it. And that's something that we really need, you need to watch if we were to get in to that one.
But looking at this historically, you go back to that high there, which was March 12th. Back
in March. Yep.
So from March to now, it's been between 100 and 110. So if you had sold a $10 wide Iron Condor, you'd have been great. It would have been a total winner right there. Yep, and so that's correct. A great example of it may go up and down in the meantime, but if it stays between your strikes, then you'd be all right.
You're going to be fine, right? So, just as a first step here, let me. What I'd like to do is go to the cherry picked ones, right? So, and then we could actually look at Chevron if we want to on this too. If we take a look here, but now one of the things I like about this view is that these are 3-month charts. What we want is something that's going to be stagnant, and you can see these are not. I mean, while this looks like this is trending up, mind you that from down here to this is from 28 to 30. This is not a big number, right? So even though this looks like it's trending up, it's in a pretty narrow range. Same with all of these. So the one here that looks to me like the best cherry pick of all of them is VRTX, right? Vertex Pharmaceuticals. I mean, it's just really nicely in a range. So let's just take a look at that one for just a second. And I'm going to go straight on over to the options page on this, see what we got. So what we have here is this is a 200, 210.
It's already filled in everything for the trade. That's cool.
Everything for you, right? And by the way, even has done a calculation to work between the bid-ask spread and all that for you, right? So what we're doing here is we're selling the 200 210 position. I'm sorry, I said 200 210. I'm sorry, my mistake. We're selling the $200 put, and we're selling the 220 250
210. You said 200. It's 210. You're selling the 210.
I'm sitting there pointing to it on the screen and saying the wrong number. Thank you very much.
It's the 210s and the 220 250s.
That's like me pushing my button on my mic to mute it and screaming to it. Right? I'm doing really well with that today. Yeah. So the 210, 220, 250. So I have, between my buy and sell here, I've got literally $12.50 range on that. And then what we're going to do is we're going to go out further, and we're going to buy. And in this case, we're going out another $10 on each of these. So from the 200 on the low side on the calls, on the puts, and on the high side, the 230, 250. So each of those, and by the way, the way this is generally thought of is the center strikes are considered the body, and the outer strikes are considered the wings. So the body is wide. It's a 1250 wide body, and my wings are only $10 wings, right? And they have to be the same distance on both sides, right? Between the center can be whatever. You can stretch that as much as you can and make it work. But then the buy sell spread on one side needs to be equal to the buy sell spread on the other side. So in other words, on my puts, I've got between 200 210, $10 spread. On the calls, 220 250 to 230 250, again, $10 spread. So those need to be the same. And you can see here what we're looking at on this. And I think this is really interesting, because and notice the room I have here on the chart for this to stay, right? And if it just stays within that range, just for people that are watching us here to see this, let me just show you this here. You see the light green area, the entire activity back quite a ways would stay. And the reason that light green area, that area is that narrow, is because that represents how long I'm in this trade. This is a 14-day trade. We're talking about May 21st options here. So 14 days to expiration. So this only goes back 14 days, right? So that's how much time moving forward I have to consider.
Right? I like that. That's cool.
And so, but if you look at this, it's been that way all the way back since February, right? February 3rd, from February 3rd today, it's literally been in that range that whole time. And all we're looking for is another 14 days.
I really like how it's like a backward look at how this is performed. That's really cool. I didn't notice that before.
Yep. And by the way, if I change my timeline here, I don't want to do that because it'll shift what the trade setup is. But if I change my timeline here, you'll see this would be bigger or smaller based on whatever I have. So it just gives you a nice little reference point. Chris, here's the thing. We know that past performance is not always indicative of future results, but we all look at it, right? We all look at the chart on what happened and what we think is going to happen. And so we just help you out with that and give you a little bit of a time frame there. So in this particular trade, if this stays within that range, I am taking in a $3.98 credit, which is $398 on a one lot trade. And we'll stay on a one lot for discussion here for a moment. Now, what's my risk? The way the risk is calculated, it's between your buy and sell strikes. Now, remember, we were buy and sell strike here. On the put side was $10 spread between 200 and 210. The buy sell on this, on the call side was again, 220, 250, 230, 250, still $10. So your buy sell spread, $10 minus your credit of, for round numbers, let's call it $4 for just a second, $4. So I have $10 spread, $4 credit. That means my risk is $6, right? In this case, it's actually $602 because it's not quite there. So $602 is my risk. So $602. So here's the thing. If it stays in that range, and it's been in since February 2nd for another 14 days, I make $398 on $602 of risk, or a 66% return on risk in 2 weeks.
That makes a lot of sense. And I really like the fact that the platform like cherry picked this. And it did that because, like you were saying, back to like February 2nd, a trade like this would do really well. So this is cool.
So what it's going to do to cherry pick, by the way, is it looks at where, now, in fact, let me just bring this up here. Here is let me get rid of this. So this is the area charts, the stock chart. I'm going to just hide that from it so it's easier to see here. The blue line here is the implied volatility. The green line is the historic volatility. In other words, the green line is the stock's behavior. The blue line is the anticipation of that. Well, if the stock is down here and this is up here and it's already in a downward trend, the odds are that unless there's not a driving thing, because the other thing this does is it makes sure there's not an upcoming earnings report or something like that could cause a driving move on it. So, the odds are this is probably going to move down closer to the HV, at least closer to that red line, which is the 1 year low of the implied volatility. And so, we've got a pretty good setup here. And the other thing it looks at is what the option prices are, and does the math work to have a decent return, and so on this. So, so right now in this particular case, if the stock just stays, by the way, notice I said between the strikes of 210 and 222.50, but I actually have more room than that. And I can go through all the math of the calculations, but it actually does it for you right down here. My break-even point on the low side would be 206, right? Now it's at 214. So it gives me a little bit of room there to move, right? So down to 206, an $8 downside move. And on the upside here, it's 226.48, right? So right now it's again 214. It's got a 12. It could move up as much as $12, and I'm still going to make money on this. Move down as much as $8, and I'm still going to make money on this. And it only has to stay within that range in the next 8 days.
And Rance, can you go back to the original scan under the fine real quick? Because you mentioned something I think that's really important here, which is, obviously when you're doing one of these types of trades, what don't you want? Well, you don't want the stock to move. What can cause the stock to move? Earnings is a great example.
Yeah.
If you go to the actual strategy, right, and it lists here some of there's more criteria than this, but notice how it even says no upcoming earnings report. That's part of what goes into this scan to make sure that you're not going to get hit with earnings in the middle of your Condor trade. So we already filtered that out.
Smart.
When we're looking through all the stocks.
So we want to make sure that's got reasonable. Now we've put in here reasonable volume, but the reality is we look at both stock volume and options volume, because right, if you don't have decent liquidity, what happens is bid-ask spreads get too wide, right? Things like that happen, right? So we want to make sure that that you've got the right kind of volume to do this. No upcoming reports, the right volatility situation. The stock price is within its like 1 month high-low range, stagnant stochastics, there's all these different things that it does. We want to make sure we have at least a 20%, and I generally want a bit more than that, return on my risk. That's our threshold on it. I'm usually looking for about 30% minimum. This one's 66% return on risk. So, that's the situation in there. So, and if you look at, again, this is going through all of these criteria to come up with this, comes up with this particular trade. We already looked at the volatility. We've looked at that. Now, one of the things that's kind of cool here too, is if I hit the trade button, I can go and, actually I want to be in an account that I can actually trade. That account's a logging account. That's for if I want to log a trade that I'm
like
not
if you're out in the
doing.
forest and you're cutting down
Well, that's
trees.
logging. Yep. It's actually, if it's an account that you have, if you have an account at a brokerage firm that's not supported by our platform, because we connect to a lot of different brokers, but if you have an account that's not supported by the platform, you can still log your trades here and track them in the process. That's what that's about. So, so you click this. I'm gonna hit the trade button, but I'm not gonna actually do the trade. I'm going to stage the trade. The reason I want to do that now is if I go over to my chart, I can see how this is going to play out on the chart even longer.
Show me how you did that.
All I did was I went in here and clicked the trade button. And when you come down here and you click the review to actually trade it, right? Right next to that's a stage button. And if I stage that trade instead of actually execute it, it'll put it in my staged orders. So right there it is. Right here's that trade. So it's in my staged orders. And now if I go look at the chart, it's going to show up with these lines on, on here for me. Now, the cool thing about this too is I've already done my analysis on that page, right? In fact, one of the great things about staged orders is, generally speaking, you're going to run out of money before you run out of opportunities, right? So you can go do a bunch of research. Oh, I like this trade. I like this trade. I like this trade. And you stage them and then cherry pick off the ones that you've staged to which ones you actually want to execute. So it's kind of a cool way to do that. But if I have a staged trader, now the thing about this is, look at it. Literally, you're seeing that other than just a couple little days there, you're back here literally all the way back to February. And then just look at this. If you looked at before that, look at how long this was stagnant. Right? Look at how long this was stagnant, right? So this is not a stock that tends to take off too much. And then this was an event-driven thing.
Super cool. So earlier we were showing the look back period over 14 days, which would be the life of the trade.
Right.
But now we're going just like as far as you want on the chart to see how this would look. Yep. That is really cool.
And then, by the way, now I've already done my analysis on the numbers and pricing and all that, and I staged it. So now if I come in here and I look at this and I see how this is playing out, I go, oh yeah, this makes sense to do. All I have to do is hit the trade button right here. Right. If I have a staged trade, the trade button only shows up if you're in a position that you could close, or if you have a staged trade that you could execute. And so if I click that, what'll happen is it'll bring up the trade button. It'll bring up the trade ticket. You'll see everything filled in exactly like it was. You're seeing that 398 price, exactly like we talked about. Now I decide I want to do that. I'm going to go ahead and hit that button, and we'll go ahead and place that trade. Again, this is an educational example, but just sharing that with you. Right. So now I have that trade. And then as soon as I do that, now I notice this. Now it shows up instead of those dots. Those dots mean it was staged. Now it shows up as dashes, meaning that it's a working order for me. It's actually been placed with the brokerage and it's working. And then as soon as that fills, those dashed lines turn into solid lines, and that will stay there until I close the trade. So I always have this reference every time I come back to this chart until I close out this trade. I'm going to have these lines as reference points for me to be able to keep an eye on what it's doing, right? Because if it starts to break out of those, those red lines, now the red lines are the strike prices. That's not my break-even point. It's the strike price. So if it starts to break out of that, I'm going to probably want to make a move. So even if I did it back in here, this may not have been a loss. It may have just been really close to break even. But it just gives me a nice visual to kind of watch through that, through the life of the trade, to make sure that, it's staying within the bounds that I hope it stays within. So what we just did was we went out of the money and sold a call and a put, and then we went a little bit further out of the money and we bought those. And so just to illustrate this a little bit different, I'm going to take ADP and I'm going to play with it instead of staying with exactly what it said here.
All right, and I'm gonna do it with you so I can learn how to do it.
And there's something about this one I kind of liked. The other one needed the numbers to work because of the strikes availability and all that. But there's something I want you to notice here. So I just hit ADP, came into the options page, and you'll see the trade. And in this particular case, now I'm going to tell you something. This is one of those that it's a scan. So it's not a do it for you. It's a scan. So it's a good starting point. And a lot of times they're great points to work with, but you want to look at this. And I'm looking at this trade and I'm saying, you know what? I'd like this to be a little bit, I want a little bit more room for it to move up. It's been tickling that a couple of times now. You see that right there?
I do. Yeah.
And so let me go big on it real quick here. Right. So you see that where it's just a little close. In fact, this morning when it opened, it was actually into that range. I'm like, yeah, you know what? I want a little more room to work there. So what I'm going to do is I'm going to take this entire trade and roll it up. So now you'll see it's got like nicely right in that range now. And all I did was just hit the roll up button. Now, the thing about this is you got to watch your prices here because what that warning that came up with, if you look at the natural on this is not great. It's a 30 cent debit to 30 cent credit. So you probably, again, it's one of the things that the system does in trying to figure out the right position for this. In this particular, actually, let me go back.
But it's,
I
it
think it's
also,
because your calls and puts are the same.
yeah,
strikes.
the strikes are the same.
Okay, that's what it did. That's what happened there. All right, let me go back to it in the original. Okay, all right. So that makes sense, right? So I can manually adjust. I can roll it. There's other ways to this, but here's what I want you to notice here. So if I look at this, the 97, the upside of this is a little bit disturbing to me, right? So I'd like a little bit more room on the upside. Well, I can do that manually too. I can take this 82.50 to 95. Let's take that 95 and let's take it up a little bit higher here to the, let's say 95. If I take that to the 100, I'm sorry, 195. I was like, the 95, let's go to 97.50. All right. So 97.50. Now I just gave myself more room, but it did change my gains here to 19%. Well, I said I want a minimum of 20. I try to target more than that. Well, I can change that a little bit in my price by just using my slider here. And now I'm at my 30% target. Now that might be a little aggressive in the bid-ask spread, but so if it comes to me, it comes to me. If it doesn't, it doesn't. Right.
Right.
So if I get filled, I get filled. If I don't, and I'm filled at 30% reward capability on this. And again, I'm in 2 weeks, and now I've given it a little bit more upside range to work. So the thing that I want people to really get in this is that you want your body to be as wide as possible. The two center strikes.
Maybe when it comes to this, I don't want my body to be.
Well, I know, right? I mean, I'm working right now and trying to drop that one down. But the Condor body, here's what you want your Condor to have a big body and little tiny wings, right? That's what you want ideally, because the wings, the difference between what you buy and you sell, that's your risk factor in this, right? That's your risk minus your credit. Whatever your credit offsets the risk. But in this case, 180 to 182.50. I have a $2.50 wing, and I have a $15 body. Right? You follow me? I got this wide range for the stock to be able to move in, and my risk factor, the tighter the between the price you bought and sold, and again, the distance between what you bought and sold on the put side and the call side are going to be the same, right? In this case, $2.50. You want that to be as narrow as possible, and you want the body part, the center strikes that you're selling, to be as wide as possible. That's going to help increase your odds and at the same time reduce your risk. And so that's really what you want to try to go for there. And again, you want something that has a strong probability of staying within the range. This had a run up. What's the, if you look at, let's go again, let's do that same thing. Let's go hit that trade button and stage it so we can see this over more time on the chart than that little sliver that it has to stay within. I mean, still, even with that run up and drop down, this is nicely within that range. It's showing a point of resistance. And again, my break even's a little bit above that red line there. But if you look at this, it had that run, it had a run up, pause, the run up, pause, right? So is this, is this a good trade? We'll find out in 2 weeks, right?
Yeah.
But if you look at the stock's behavior, it's within, and by the way, this is payroll company. This is ADP. This isn't like a high-tech stock that could go, this isn't like some news on Tesla that's going to make it fly.
Teslas can fly.
Well, one has proven that it can. It took a big rocket strap to it to make it happen, but they did send one up to space. So,
yeah.
You probably saw that yesterday he landed the big one for the first time without.
Oh, that's good. It didn't blow up this time.
Yep, didn't blow up this time.
Blow up. Yep.
Yep. So he considered it a failure though, because one of the heat tiles fell off, but it stayed together. But anyway, so that's my range thing again. And again, I'm over here, I'm looking at it. I've got that longer term range, and I could leave this here while I go search some other ones and so on. And then when I'm ready to come back in here, just hit that trade button, ready to place that trade and fire it off and get that one done too. So, so that's the a little bit about the Iron Condor and some of the benefits here of doing it in market gear is, that it helps you find them quicker and cherry pick them and, all that stuff. But
I got one more thing too. I always
Yep.
like to hit Chris with a curveball right before we wrap these things up. So let me give you one little feature, and Rance, don't click on anything yet, but okay, Chris. So what did we do here? Let's take the VRTX trade or this one, either one. What did we do here? We did two things really. We obviously placed an Iron Condor. We know that, right? And we also got the original trade idea from a scan, one of the set scans. Rance, could you pick either trade, please, and go into the journal for either one of them that you've placed? There's your Iron Condor.
So here's the Iron Condor. We just put, and it's in the journal, right? So it shows you exactly what it is, right? And this is it says live. As soon as it fills, it'll say open. But
look at the hashtags.
Right. So it identified that it's an Iron Condor, and it identified that it came to us from the Iron Condor stagnant channel scan.
That's really cool.
So now
I love how it automatically does this kind of stuff. That's really useful.
Right. So now if you try to run, as you get going and you try to run a couple of these over time, and obviously you're probably doing some other things too in the market, these will all be tagged, and you can literally go back and just see the bulk of them in one line here on the right. It'll say there's the Iron Condors he's run, but also anything that's come up in that scan, since it hasn't executed yet, it's not showing here, but once it executes, it'll show you all the trades you've done from that scan, so you can see whether or not you're making money from the scan that we've developed.
Nice.
And so I happen to be on one of my demo systems here, so I need a little more time to show you a little bit better result on some of this. But if you look at this, and again, I don't think a lot of the condors on this. Oh, there you go.
You got one right there. Yeah.
Right there. No, it's not one. Iron Condor stagnant channel, 16.
Oh, that's the category.
Trades,
okay.
Right. That's the category, right? From the scan. Specifically from the scan. Now, if you look at this, I've got my Iron Condor and I've got my Iron Condor stagnant channel. So the Iron Condor, just how many Iron Condors I did, right? So I did 28 Iron Condors. And I made on average $840 per Condor. And for almost everything we do here, because we use this for education, all that, we're doing single lot trades. Right. Because I don't want to go show somebody a $6,000 risk trade. I'm doing a $600 risk trade. Right. So $840 on average profit on this. I've done 28 of them. I've won 64% of the time. And my average time in trades 49 days. Here in my Iron Condor stagnant channel, here I've done 16 of those with an average profit of 1,400. Right. So 62% winners on that one. So now I'm going to tell you 68 days in this, which is usually not how long we're in those. The reason that's coming into play was there's been a couple of times in Iron Condor that between the spreads, I realize I'm going to have the stock put to me, and I don't mind doing it because if it's between the spread, that means it broke a resistance, right? Especially on the upside. So if I have the stock put to me, I've got it a little bit of a discount anyway, and now I can continue to ride it higher if it broke through that resistance, right? So that's why that happens. Now that's a little bit more. You follow what I'm saying there? I don't know if I don't want to confuse your listeners.
Yeah.
Yep. And it's just one of those things that just for our listeners here to follow that for just a second. By the way, look at this. I was filled. Remember those were dashed lines across the screen before. Now they're solid lines. That means I got filled in the trade. Right, because now I'm in the trade. So here's what happens. If this thing were to break out, were to do something, if I want to stay in it, I can stay in it, even though it may have been something I might have normally wanted to consider bailing on. I can assess that and either get out if it's not working, or if it's something that can work for me, I might want to hang with it. So that gives you the ability to do that. So that's a little bit on the Iron Condor. We went into a little bit of more detail on the screen here for it, but again, what this does is it generates cash flow. And when you're talking about the two we looked at were both 14-day trades, and in 14-day trades, we were looking at 30%, 60% returns in 2 weeks. Right.
Well, my biggest takeaway from this is the look back period, because that seems really intuitive, right? If you're looking to put on a 14-day trade, just look backwards 14 days and say, does this trade make sense?
Right.
And anybody can do that on any platform. But it's the fact that like on here, it's just automatic and it does that. And I probably could have used that earlier in my life. I probably could have used that a lot.
And by the way, we're showing this. This is I just came in without from a scan. It just defaults to under 30 days, right? So it's 28 days in this one versus from a scan where it's doing all that math for you. But if you just look at this, if I want to go, it's going to give me all these warnings because of it's saying this isn't a good one. But like now I'm at 42 days. Not something I do, but you can see how far back that goes on the chart. And what we were looking at earlier was a 14-day, and in the 14-day, we were talking about. I clicked that a few times, so I got to keep pulling it in that 14-day. You can see as I'm doing that, every time I do that, this got narrower, right? And so now we're in that 14-day trade, and so that makes it work a lot better on this. So that's it's really handy to have that back here, so you can see exactly what have that reference point of where you need it to stay. And again, that little staging thing drives it over to the chart, so you can look at it over a longer period and all that. Also on the chart, you can have your HVIV down there at the bottom and look at that as well, so you can get a little better assessment if you want to. But the thing about this is, we make it a lot easier in the platform. I mean, people ask me, well, how do you find these? I click a couple buttons and but I don't know. But let's just talk about that for a moment so people can, have a little bit of idea what to do here on it. You generally, if you look at stochastics is an oscillator, right? So if it's tending to oscillate within that range, if it's the tighter it is, it's going to be a lot narrower on your stochastics. You don't want stochastics that are hitting overbought, oversold. You don't want those wide swings. You want them to kind of stay in a narrow range. That's one of the indicators I would use here on this. And the other thing is, look at where your support resistances are, because if it's tending to bounce within those over a recent period of time, and you have those support resistances there, that's going to have trouble getting through. That's exactly what you want. You want to have it trouble going up or down, right? Just right in that range. And those are two things that I'm going to do technically to help isolate that, besides some of the other things that this will look at. And then consider what you're in. Just be careful. Don't go. Make sure you know when the next earnings report is. By the way, this is a great thing to do right after. Now, I know people will do it coming into earnings because the volatility is so high. I have not been super successful with that, because I'm picking ones that I don't think are going to move and they end up moving on me. What I'd rather do is, just
exactly what I've done in the past.
Right? Yep. But if you wait till the report comes out, and then what's going to happen is the volatility is going to drop, and then it's going to bleed off over several days. So if you get in right after, it's like, and it didn't really move, right? It didn't have a pop one way or the other. There's kind of boring into earnings. That can be a great time to get into, because now the news is already out. You don't have a driving force, right? If it's popped, that's not necessarily a good time to get in, because you don't know how the market's going to continue to react to that pop. Is it going to continue to running higher, lower? Is it going to stop there? If it's boring through its earnings, that's a great consideration as well for it. But you really want to watch. You don't have a driving force coming up that could move it. And, additionally, be smart of what stocks you go into. Don't go into the super high fly or high tech type of stuff.
Well, and the other thing I would say, I know we're pushing time here, but we won't show it today, but obviously there's back testing in the platform, so you can go back and test these things and actually see how if I started on this date with this range on the chart, how would it have played out. The other thing too, with the strategy like this, obviously it's a high percentage potential return for a very short period of time, and you can get out of the ones that don't work, so you don't have to take that max loss. But the biggest thing is, when people are playing with these, you don't take a $10,000 account and put the whole account into one of these trades, right? You break it up, because you lose one here, but the ones that work and the ones if you're going to win a high percentage of them, and with that kind of return, it adds up over time. You just have to cut the losers.
Yeah.
And if you want to practice that, by the way, one of the things that we have in here, we have virtual accounts. You can go do them in virtuals and, see how you can use the back testing to check it out. But then, seeing if you're going to make the right judgment calls, you can, do a few of these in virtual account before you're risking real money too, and just make sure you kind of got it down. But that's exactly the way it plays out, and, again, just as a final point on this to wrap up the rules on this, some things to consider. having an expectation of a drop in volatility or at least no increase in volatility, not an upcoming event that's going to drive it higher, is a good thing to do. I can't emphasize enough wide body, small wings. That will help manage your risk a lot more effectively. And then, consider upcoming events. And I say consider because some people like to play these on earnings. I just don't, because it's an unknown. I'd rather get through the earnings report and then do it. So that's, that's what I'm trying to do here on it. So, and by the way, I know you mentioned this in the beginning, but we showed several features today of market gear, and you bent our arm a little bit to get something really cool for your listeners here. And if they want to check it out, they can go to marketgear.com/Chris Uhl, and they get 2 weeks for free, but they also get an additional 50% off their first month to give it a try and look at this and play with some of these things. That gives you certainly enough time to ride through a couple condors and see how it plays out for you.
Absolutely. Yeah. So guys, this has been super useful. I love learning about the different trade strategies, and I'm sure the audience got a lot of value out of that. Plus, being able to see it in market gear is really neat as well. So thank you so much for your time and coming back on the show today.
Glad to be here. Enjoy.
Thank you guys for tuning into today's How to Trade Stocks and Options podcast. Make sure you like, subscribe, and enable notifications. That way you never miss any of the tools, tips, and tricks we upload every single week to help you trade faster and trade smarter. And I'll see you on the next episode.
Okay, so what'd you think? That was pretty incredible, right? Now, if you like that, that's only a taste, only a sample of what you're going to find in the full AI stock trading system. And I really highly encourage you to go and check this out. Obviously, you are interested in learning on how to trade, and that's why you're listening to this podcast. Now, I'm going to take and download my entire trading system that I use day in and day out onto you. And the only way I'm going to be able to do that is over at the AIStockTradingSystem.com. You're going to get phase 1, 2, and 3, several bonuses, and on top of that, I'm going to walk you through over a dozen trades that I put on inside of my account, holding your hand and showing you exactly how I got in, how I got out, how I use the artificial intelligence data, and how this could work inside of your own trading portfolio on a daily basis. So make sure you head on over to AIStockTradingSystem.com. That's AIStockTradingSystem.com to learn more and to get started and to download my decade plus worth of trading experience into your hands so you can start using the AI stock trading system today, the 5-step system to take the guesswork out of trading. Hey, if you like this video, let me know by leaving me a like below, and then subscribe and share it with somebody you think could use it as well. Be sure to comment below with your biggest takeaway from this episode and any suggestions you have for future episodes. And finally, make sure you watch these other videos to help you trade faster and trade smarter, and I'll see you on the next episode.